Welcome to the Wise Wolf Project. I'm your host, Wise Wolf. It is December 31st, 2010, almost to the beginning of the new year. Uh, in front of you, I have basically the CNN money page. And I was interested in this market tracker. Uh, and this is going to be real short. Now, I want to, in this tracker, you'll notice they have the price for the Dow, the NASDAQ, the S&P, 10-year Treasury, oil, and the dollar. Um, Now, the question I have of is which out of these six do you think is most important for your well-being? Um, Most people, if I said that, uh, obviously the first three are related to the stock market, American stock market, and I would probably get a lot of people who really concentrate in these three areas. But my personal opinion is the invisible, or it's the things that we don't see, the things that we don't look are actually more important. Treasuries, oil, and dollar are really the most important on this screen. Uh, I'll tell you why. Treasuries, especially with the 10-year yield, basically says how much our treasury has to pay interest for bonds that they have sold. Uh, if this keeps rising, then that means more you have to pay. Obviously, you're going to have a cash flow issue if you continue to pay more than what you bring in. That's important. Oil. Oil is important for several reasons. Um, Oil impacts everything from the clothes you buy, Tupperware, getting back and forth to work, if you're driving, all is very important. One of the things that happened back in the 70s was the U.S. struck a deal with the OPEC nations to use the dollar as the currency to buy oil, which means that there's an artificial demand for dollars because you have to have dollars to purchase oil. So that creates, it's very important. Uh, Also, we also know that for the past few decades, rising oil prices have sparked recessions. So when in 2008, when the oil price went to 100 and roughly $140 an ounce, it sparked people couldn't pay their mortgage because they had to put more petrol in the gas tank, and it set off this whole chain of events, which leads us to now. Well, this fell to $34, roughly $34 a barrel. Now it's uh, almost close to 100 again. Once this gets over 100, which I think it will probably in the next 2 months, maybe February, March timeframe, that's going to be some serious things to deal with. Pressure on the economy. If you've noticed, gas prices should be going up, and this is one of the ways I can tell gas prices are going up is when I see this oil price going up. Next, the dollar. So crucial. It's the reserve currency of the world. Everybody needs it. Everybody wants it for some reason, or for whatever reason they need. Maybe it's to purchase oil. In some countries like Zimbabwe, our dollar is their currency because they've experienced hyperinflation. Now, the dollar and oil are very closely linked. As this goes down, uh, commodities, not just oil, but gold, silver, corn, hogs, cattle, all of that stuff goes up in price as this goes down. So these are very important because they directly affect you and your everyday standard of living. You may not be invested in the S&P. You may not be invested in the Dow or the Nasdaq, but these three here definitely have an effect on your standard of living. And so when I look at this page, I mean, I see these three, Dow, Nasdaq, and S&P, but more importantly, I see Treasury, oil, and dollar, and they are all linked together, all linked together, all linked together. When people such as John Williams, I was listening to him earlier, talk about hyperinflation, these things are critical in that. If the only thing that's really holding up the dollar are right now are really about three things. One is temporary. The other two are semi-temporary. I'll get to that. Um, the temporary thing is the euro crisis, and I know today it's down, but it's really been up. It's really been rising over the past month or so because of what's going on in Europe, and so that's given some artificial propping up of the dollar. But that's only temporary. Our situation is just as dire as theirs. Um, and if should people uh, believe that or believe it to the extent that it's urgent now, they'll start pulling their money out of the dollar and getting into other currencies. The second thing that's holding up the U.S. dollar is the purchasing of U.S. bonds by um, countries such as China, Japan, and currently I know China, for instance, is really scaling back. I don't think they're purchasing anymore, and they're probably letting their bonds roll off, and which basically means they let them mature and they don't renew with another purchase of bonds. Um, so and the Fed currently is, buying the debt now. They are our own Federal Reserve is the number one U.S. Treasury bondholder, which says a lot, and that's not good. So the purchasing of our bonds here supposedly keeps this value down, this yield down, which says that we don't pay as much in interest on those bonds. So that's important. And the major thing is the dollar, petrodollar, the ability to purchase oil with dollars, uh, because it's mandated by the OPEC nations, is one of the things that are uh, keeping us from actually entering into a type of hyperinflationary situation. If we continue to debase our currency, which I see no end to, eventually the OPEC nations will say, you know what, we don't want this. Our raw material, our natural resource, which is oil, is more precious than the pieces of green paper that you're giving us, and that we have to accept. And once that link is broken, once they take that off, um, it's over. It's really over. And our military might is really what's keeping up the dollar. So the petrodollar, our military, and the purchasing of bonds really are what's keeping our dollar really up, and temporarily the euro crisis. But should any of those break, especially the petro dollar issue, um, we have a world of hurt coming to us. So again, when I look at this, I'm looking at the trend of the last three, not the first three. Remember, the invisible is more powerful than the visible. Think about it.